Okay, but what if the market isn't making a dramatic U-turn? What if it's just on a long road trip and, it just needs to pull over for a quick break? Well, that's where our second family of patterns comes into play. Yeah, these are called continuation patterns. They don't signal some big, dramatic reversal. Instead, they signal consolidation. Think of it like a spring coiling up, just building and building energy before, most likely, springing forward in the same direction it was already heading. It's just a brief moment of indecision before the conviction returns. So a continuation pattern, really, is just that, a pause. It's a period where the buyers and sellers are a little more evenly matched, and that causes the price to just trade sideways in a tighter range. The market is taking a breath before it decides what to do next, and very often, it decides to just stick with the original plan. And you'll see a few classic rest stop shapes. Triangles are a great example. That's where the price range gets tighter and tighter, kind of like an argument between buyers and sellers that gets quieter and quieter before one side finally wins. Channels are just when the price bounces between two parallel lines. Look, don't worry about memorizing all of these right now. Just remember the core idea. They represent a pause, not a dead end. So we can spot a potential U-turn or a little rest stop. That's great. But how do we, as map makers, actually use this information? Well, that brings us to a really simple three-step framework for taking action. This breaks it down perfectly. Step 1. You identify a potential pattern that's forming. An M shape, a triangle, whatever it might be. Step 2. And honestly, this is the most important part. You wait. You wait for confirmation. That means waiting for the price to actually break out of the pattern, like breaking through that neckline we talked about. Only then, as your third and final step, do you plan your trade. This is so critical, it really deserves its own moment. Anybody can see a shape on a chart, right? But an unconfirmed pattern is just wishful thinking. The breakout, that moment when the price moves decisively past a key level like the neckline, that is the actual signal. Patience is everything here. Okay, before we wrap this up, there is one last, incredibly important rule for all you aspiring market map makers. It's a rule that helps you navigate the real world, which, let's be honest, is always way messier than the textbook examples. So please, remember this. The market is messy, it's human. Prices aren't going to bounce perfectly off a line you drew with a ruler. A neckline isn't going to be a single price down to the last penny. The best navigators, the best map makers, treat these lines as zones or areas of interest. They look for a reaction in that general area rather than demanding absolute perfection. You see, learning to read these patterns is like learning to read a map of market psychology itself. It's not a crystal ball, it won't predict the future with 100% certainty, but it gives you a powerful guide for understanding the landscape. So the only question left is, what stories are waiting out there for you to discover?